$5.9 trillion. Gone. Not in a year, not in a month. In 30 minutes. Let that sink in. Imagine waking up, checking the markets, and realizing that gold and silver, assets people have trusted for thousands of years, just experienced one of the most violent price moves in modern financial history. No warning, no mercy, just red candles slicing through screens while traders froze, panicked, or got wiped out completely. Now here's the uncomfortable question you need to hear right now. If this happened again tomorrow, would you be protected or would you be collateral damage? Because this wasn't just a random glitch. It wasn't one bad day. This flash crash exposed something much bigger, much more dangerous, and much more relevant to your money than most people realize. It revealed how fragile modern markets really are, how quickly safe assets can become unstable, and how unprepared the average investor truly is. You've probably been told that gold and silver are boring, slow, safe, the place you hide when things get scary. But what happens when the safe haven itself starts shaking? What happens when algorithms, leverage, and global panic collide, and you're standing in the middle of it with your savings on the line? In this video, you're going to understand exactly what caused the gold and silver flash crash, why trillions in value can vanish in minutes, and, most importantly, what this means for you, whether you're a beginner or already investing. We're going to break this down in plain English. No hype, no conspiracy noise, just real mechanics, real psychology, and real lessons you can actually use. And let me be clear, this topic matters right now. Not someday, not when things calm down. We're living in a market era driven by speed, leverage, and emotion. Interest rates, inflation fears, geopolitical tension, and AI-driven trading systems are all colliding at once. Flash crashes aren't rare accidents anymore, they're symptoms. By the end of this video, you'll see gold and silver differently. You'll understand how these moves happen, why most people are caught off guard, and how smart investors think before chaos hits, not after. So take a breath. Stay with me. Because the next few minutes could completely change how you protect and grow your money in a world where trillions can disappear before you even finish your coffee. Let's get brutally honest for a moment. Most people think they understand risk until they experience it. They say things like, "I'm in it for the long term," or "Gold is safe, it always comes back." But when prices suddenly drop hard and fast, logic disappears. Screens turn red, news headlines scream, and emotional decision-making takes over. Here's the reality. Most investors are not prepared for speed. They're prepared for slow declines. They're prepared for corrections that unfold over weeks. What they're not prepared for is a violent move that happens faster than their brain can process. That's exactly what a flash crash is, and why it's so destructive. Think about the average person investing in gold or silver. Maybe you bought some ETFs, maybe you hold mining stocks, maybe you dabble in futures or leveraged products because someone on social media said it was easy money. On the surface, it feels responsible, conservative even, but beneath that calm surface is a system loaded with leverage, automated trades, and fragile confidence. One of the biggest mistakes people make is confusing historical safety with short-term stability. Yes, gold has preserved value for centuries. That does not mean it can't drop sharply in modern electronic markets. When selling pressure hits, especially forced selling, it doesn't care about history. It cares about liquidity. Another painful truth? Many investors don't actually know why they own what they own. They buy because someone said it's a hedge, or because inflation is trending, or because the dollar is doomed. But when prices move against them suddenly, that shallow understanding collapses, and fear fills the gap. And fear has consequences. People sell at the worst possible moment. They lock in losses. They swear off investing entirely. Or worse, they double down emotionally without a plan, hoping to make it back, which is how small losses turn into devastating ones. Ignoring these realities doesn't make you safer. It makes you vulnerable. The gold and silver flash crash wasn't just a market event. It was a stress test, and most people didn't realize they were being tested until it was over. That's the danger. The damage happens before understanding catches up. If you don't take time to understand how these moves happen, you're trusting your financial future to hope. And hope is not a strategy. So let's slow this down and explain what actually happened, clearly, simply, and without jargon. A flash crash is a sudden, extreme price drop that happens in a very short time frame, often minutes or even seconds, followed by a partial or full recovery. It's not driven by long-term fundamentals. It's driven by mechanics. Here's the key concept you need to understand. Liquidity. Liquidity is how easily an asset can be bought or sold without affecting its price. In calm markets, gold and silver are highly liquid. But when large sell orders hit all at once, especially during thin trading hours, liquidity can disappear instantly. Now add leverage to the mix. Many traders don't just buy gold or silver outright. They use borrowed money through futures contracts, margin accounts, or leveraged ETFs. This magnifies gains, but it also magnifies losses. When prices drop quickly, margin calls are triggered. Positions are forcefully liquidated. That forced selling pushes prices even lower, creating a feedback loop. Then come the algorithms. Modern markets are dominated by automated trading systems. These algorithms react to price movements, volume spikes, and technical levels, not emotions, not logic, not long-term value. When certain thresholds are broken, they sell automatically, fast, relentlessly, without hesitation. Put it all together, and you get this chain reaction. A large sell order hits, prices drop, stop losses trigger, margin calls force selling, algorithms accelerate the move, panic spreads. That's how trillions in paper value can vanish in minutes. This doesn't mean gold is broken. It means the market structure is fragile. And understanding that structure is the difference between being shocked by volatility and being prepared for it. Now let's go deeper and make this practical. Imagine two investors during the flash crash. Investor A owns gold through a highly leveraged ETF. He doesn't fully understand how it works, but he likes the returns when gold goes up. When prices suddenly fall, the ETF drops far more than spot gold. Trading halts. He panics. By the time he sells, the damage is done. Investor B owns physical gold and a small unleveraged position in a gold ETF. He understands volatility. He knows his risk. When prices drop, he doesn't react emotionally. He watches, he evaluates, he survives. The difference isn't intelligence, it's structure and preparation. One critical insight: volatility hurts most when you're overexposed. Flash crashes punish concentration, leverage, and blind confidence. They reward patience, diversification, and humility. Another insight: timing matters more than predictions. You don't need to predict flash crashes perfectly. You need to assume they can happen, and position yourself accordingly. Smart investors ask, what happens if this drops 10% in a day? What if liquidity disappears? What if I can't exit immediately? If those questions scare you, your position is probably too big. This is where risk management stops being boring and starts being survival. Let's bust some dangerous myths. Myth 1. Gold can't crash. It can, and it has. Price stability is not guaranteed in modern markets. Myth 2. Flash crashes only hurt traders. Wrong. ETFs, retirement accounts, and even long-term holders can be affected indirectly. Myth 3. If I just hold, I'm safe. Holding without understanding risk is not strategy. It's denial. A common mistake is assuming past performance equals future protection. Another is mistaking complexity for sophistication. If you don't fully understand how your investment behaves in stress, you don't control it. It controls you. Clarity beats confidence. Every time. So what should you actually do? Step 1. Audit your exposure. Know exactly how much of your portfolio is tied to gold and silver, and through what instruments. Step 2. Reduce leverage. If you're using margin or leveraged products, understand that you're amplifying risk, not just returns. Step 3. Diversify intelligently. Don't rely on a single asset to protect you from everything. Step 4. Set rules in advance. Decide how you'll respond to volatility before it happens. Step 5. Educate continuously. Markets evolve, so should you. Consistency beats reaction. Discipline beats drama. Section 7. Natural CTA and trust building. If this breakdown is helping you see the markets more clearly, take a second to support the channel. Hitting like tells the algorithm this content matters. Sharing it helps someone else avoid learning these lessons the hard way. And subscribing means you'll keep getting clear, no-nonsense insights when markets get confusing. This channel exists to cut through noise, not sell hype, and your support allows that to continue. We're here to learn together, to stay sharp together, to stay ahead together. Here's the truth most people miss. The gold and silver flash crash wasn't about metals. It was about fragility, about speed, about psychology, about systems stretched to their limits. Trillions didn't vanish because value disappeared overnight. They vanished because confidence, liquidity, and structure failed, momentarily, but violently. Your biggest takeaway isn't fear, it's awareness. Understand what you own. Respect risk. Prepare for volatility. And never confuse tradition with immunity. Because in today's markets, safety isn't about what you buy, it's about how you think. And the investor who thinks clearly when others panic is the one who lasts.